So the question, I think we want to go back to this concept which has flowed through the day, that procurement is not a transactional relationship with our internal or external client, but a relationship. And the question I want to drive the conversation at the beginning is, are costs generally too high or too low in a business? And I'm going to start the debate with Chris. And I'm hoping Chris will argue that in most businesses, costs are too high. In other words, there's an awful lot of waste and inefficiency. And cost reduction is one of the ways towards greater success. Okay? And I'm going to try and argue the opposite point of view, that in most businesses, our costs are far, far too low. And that the skill of business, the art of strategy, is to increase price slightly faster than our costs are going up. But it's very difficult to secure success through overall cost leadership. We will start that debate. We'll probably start it by making our opening positions, then having a bit of a discussion, and very quickly throwing it open to the rest of you. In fact, we're inviting some others to join us right at the beginning so they can enter into the spirit of this debate very quickly indeed. Chris Sawchuk is invited to the panel. Chris, thank you. Theano, welcome back, Theano from McKinsey, to join us. And introducing David Noble, who runs this extraordinary professional club representing the future of procurement. Thank you for joining. And David is going to talk about ethics at the end of the afternoon. So he is, if you like, our moral referee. Okay. So should we sit at the end? Or, no, you come between us. Chris, you start off the debate. Costs, cost cutting is often a good thing. It's absolutely essential. Firms typically are less efficient than they need to be, and reducing costs is one of the ways to gain greater efficiency. It could be in government as well as Rio Tinto and anywhere else you care to start. I'm afraid you're condemned to listening for a bit, but I will give the signal when you dive in and join my side against the great Chris of Rio Tinto, okay? And then I will also give a signal when any of you can tap me on the shoulder, give me a break from the conversation and join in the conversation yourselves. I'm hoping, Tanya, you'll join in. You tap us, yeah, any of us, anyone. Chris, me, any of us. Anyone you don't like. Very good. So let's sit down and start. And I'm hoping Chris will open the conversation with some interesting arguments. Chris.
Yeah, I feel like I've got a hand up the middle of my back or something at this stage. Look, I think it's totally situation specific, but so I can sort of see a situation where in a commodity business, cost is always going to be paramount. It's interesting as we in the immediate environment we're in now, we're seeing a flattening of cost curves and therefore a reduction in price. So what becomes paramount is actually margin preservation as distinct from cost or price. It's margin. If you're in a pharmaceuticals or a research-dependent body of work, you'd obviously have to be talking about what is the optimum cost. Where's the value, cost-reward equation come out in terms of what's the right level of spend to get the outcomes that you need to get. But business is never single-dimensional. And this is part of the challenge with all of this process, is that we do tend to have to reduce things to single points. You talked about what is the KPI before. There's never one KPI. There might be one that gets more prominence than another, but there's always multiple KPIs. There's always multiple ways of measuring. There's always multiple facets to a decision. And so I think in our business, cost is always going to be very, very important, and it's going to be a significant part of what people are charged with. But the key outcome really that you're after, in our case, is margin preservation and making sure that your relative position in cost structures is protected, and that you maintain your production quality such that you can price differentiate versus the competition. So I'm not quite sure I've given you the same sort of lead that you wanted, but that's
yes,
where I'd come
the
out.
problem here is that I'm finding myself in agreement. But let's stay with the notion that it's margin preservation or margin enhancement that we're after. And let me recall a very interesting piece of work that was done by Deloitte last year, where they were addressing a team from Deloitte, a guy called Michael Rayner, and Ahmed Mumtaz, or Mumtaz Ahmed, I think. They took 24,000 US companies and looked at their performance over 45 years. This is the largest single performance analysis of corporate success ever conducted. They found what they called miracle workers, 74 of them, 74 firms that were clearly superior over that long period of time, over many business cycles, in terms of their return to shareholders, return on assets, and so on. And when they looked at the 74 and what differentiated them from the rest, they found three patterns. The first was what they called them rules. They're not quite rules, they're a pattern. It may be a pattern that doesn't apply in the future. The first pattern was better before cheaper. The 74 focused on non-price differentiators. The second rule was revenue before cost. The 74 were more concerned protecting the margin by enhancing revenues than worrying excessively about cost. And the third rule was that when you're trying to increase the revenue of your firm, it's better to do it through increasing price rather than increasing volume. Now, these rules certainly challenge what I was taught at Wharton many, many years ago about sources of success. But I think it's quite interesting. I just wanted to make three quotes before I returned to you, Chris. They summarize their argument as follows. Very rarely, indeed, is cost leadership a driver of superior profitability. I think of those 74, they found two of the firms which for a small period of time in those 45 years was the cost leader in their industry. The others, if anything, were the high price, high cost players. The second quote I like, this is a colleague of mine at London Business School, a professor of marketing. He'd previously been both a finance director and a marketing director of IDV, which became Diageo, the spirits company. He said, from his study of how boards spend their time, on average, boards, I think this was UK boards devote 9 times more attention to spending and counting cash than to wondering where on earth it comes from and how it could be increased. And then my final point would be that the art of strategy is to stay one step ahead of the need to worry too much about efficiency. Now,
Lost me.
do you want to throw some thought back, and then we can open it to our three distinguished?
Look, can't disagree with a lot of that. I think in many ways, I think you can say that a cost reduction strategy, if that's the only game in town, is a very defensive strategy, and it's sort of it's all it's really doing is buying your time. I think that's a sort of a fairly bald statement, but I think that's probably true. I think with regard to boards, I actually think it's actually worse than what you outlined there, because I think if you look at the very construct of boards and this market here now, if you looked at banking by way of example, the risk aversion required of a board, given the punitive sort of witch hunt type mentality that's on now with regard to the banking sector is a good example. I mean, I don't mean to stand here as an advocate to protect them or anything such as that, but it's the bias, the regulatory oversight, the number of people that they're now having to put in place for compliance and risk aversion and risk avoidance and the like, rather than embracing risk in the sort of value creating part. But that, and so when you see the construct of a board, it's a audit committee, essentially risk, a REM committee, essentially risk in this market, sustainability committees, risk. And so, you know, I think the true strategic conversation around a board table in any situation is probably If it was 30%, it'd be a great part of it. So I think there are those sorts of constraints in there. But I think the key thing from, I think it will be industry specific, and I think you will see areas where you can get out on the front foot and get very specific about it. So our investment in things like automation, removal, that's a massive differentiator if you can remove it. We have, automated trains are coming for us. Now, you've all been on automated trains in airports and the like. We're talking about 3 kilometre long, heavy haul type stuff. Now, rationale for that, we have to change the crew on that between the mine, the port and back to the mine 4 times. Crew change, we've got to stop the train. It takes 3 kilometres to stop it. It takes 3 kilometres to get it started again. So it takes a crew has to be transported out there. We spend thousands of kilometres of travel getting crews to change over point. So look, I think it will be more industry specific than the board outlines. In a commodity business where you've got no real control over your price other than sort of volume, then you're always going to be focused on cost. But find ways to differentiate your product if you can and enhance the value equation. But within this procurement debate, if people could get to the point in that customer conversation that Chris was having before, if people were true champions of value and they're truly aligned with creating shareholder value, then in a way they become their own customer if they've got tenacity to see through what they're going to deliver. And I think that's one that if you keep this, how do I get a procurement seat at the table, all that type of stuff, get past that and get on to the idea about I'm a champion of generating value and you can't get in my way because I have to deliver that value, and it becomes personalised, and if they own it, they're their own customer delivering to the shareholder.
This is the point, David. I'd like you to join in.
What do you want me to say? Right. I'll just say something, do I?
Yeah, you go for it.
Well,
You
first
go
of
for it.
all-
You have the floor.
First of all, I don't run a club.
No, sorry.
On measuring success, so I'm going back to my job before I ran a club. So I was supply director for a big multinational, reported to director chief exec. I wouldn't have survived there long talking about cost management. In fact, it was a banned word at the board, in the boardroom. It just didn't discuss it. So my point is this: that there's 2 things. It's in our DNA of procurement supply people to be analytical. That's what we're brought up, and therefore measure and measure and measure again. That's what we're comfortable with. It's something it's a paradigm shift for us to move from that. So there's a great difficulty. I'm sure I'm not the only one in the room thinking, oh my goodness, how do I measure something? It's not tangible. But the reality is, in that environment I was in, I had to fit the metrics to fit the needs of the business. And the needs of the business was to reshape that business entirely from a commodity business to a high-tech valve engineering business. And that was fundamental, and that was how you deployed your assets. And you couldn't own all the assets. They were just too expensive. So huge outsourcing make-me-buy activity where the supply director, which I was measured on something totally different, which was scary. But it created real value for that business because we changed the footprint of how that business looked around the world. So my point is this, that we have some core metrics because we have to have identity as a profession. And those core metrics, I think, are well-honed, well-developed, can always be improved. But the environments that we find ourselves in, we're not unique in it, like other professions. We have to adapt those metrics or those measurements of value to fit that environment. Whatever that environment is, and it can change quite dramatically. And the point was made earlier about this social environment we're getting into now. Many companies, again, I think, and I'll cover this in my presentation, which you've all heard today already, is about this social value, which I think because of our analytical background, we have great difficulty coming to grasp with. How can we measure something as intangible as a social value of what we do? We are the gatekeepers, I believe strongly, of our companies that we exist within, our environments, the company, the bodies we're responsible for. We are that agent of that company, managing risk and managing the social impact and the brand impact with our source bases, because our supply lines are many faceted and complex as they go down, and as many companies are finding out their cost at many different tiers, can directly impact their brand overnight, if not quicker. So there's a whole social piece here that we have to understand and find metrics around to say we've got this under control or we haven't. And I'll come back to this in what's left of my presentation in a few minutes.
Thank you, David.
Well, I actually was just going to go back to, I think the original question was around are we too low? Are our prices, how do we know cost is too low in the supply chain or, supply? And I think, the question is, I think in some cases you might go out there and, if you relate it to supply and say, well, cost can never be too low, But I think there's indicators that you have to look at, and I think there's certain, industries that are much more susceptible. If you think about some of the low margin industries, logistics, semiconductors, et cetera, we do have very, thin margins in those industries. And so, I think, you got to look at indicators to say, our costs to a point where they may be too low in our supply chain. So, for example, are you, sort of like when we start looking at, supplier financial, do you have suppliers that, the financial viability of those suppliers are at risk? And they're, and a good portion of their business is with you as a customer. I think the other things you look at is, if you're not seeing those kind of indicators, are you starting to see indicators in terms of responsiveness going down, quality going down, things like that? Are there indicators? Is cost too low in the supply chain itself? And so I think you got to start looking at those indicators and find that balance point. And the challenge is, unless you have, sort of like the Japanese kuritsu, those intimate relationships where you're sharing your costs, et cetera, it's going to be very difficult to have that transparency to know, when are you going to be too low, unless you're looking at some of these, other indicators. So.
And I agree with that. I also want to bring in the discussion the notion of return on investment. And the investment doesn't have to be a capital investment. It's a return on anything actually we spend. And that is a mindset as well as a metric, if you want. So I find it usually helpful to think of what is the return on every euro or dollar we spend. And there may be alternative ways to actually spend a euro or a dollar, or actually half a euro or dollar, to get to the same outcome. And what are the outcomes we really want to achieve? Because very often if you go too low, you have diminishing returns on investment. And specifically around the procurement functions contribution, I think it's an important way to, kind of part of the language that procurement is using with customers or clients or stakeholders, whatever we want to call them in the end, to talk about the return on investment, and often enabling discussions around substitutes or around actually not making an investment at all, but also around what is the right outcome we're targeting for.
In the spirit of the fish tank, I'd like to go back to, David, you were talking about social value, and you were talking about the metrics that are set quite clearly for organisations in terms of delivering that social value. And this morning we heard, ranges of, say, 20%. And my question to you, David, is are those metrics quite clear in terms of what social value means?
We've got lots of microphones.
Oh, thank you.
There we go.
By the way, that's lovely. It's a conversation amongst
There we go.
yourselves,
Feel
not
free
with
now.
us.
Okay.
To be strictly true to the fishbowl. Thank you for demonstrating that.
Can I just ask, before I answer that question, is Ilinga still here? Ah, good. I thought you'd gone. We were debating this earlier, that's why. I mean, the cop-out answer is I don't have a set of values. I think my friend up there, who I'm going to talk to soon, does have some ideas around setting some sizing around that, which is important to get the metrics out there as an independent standard, if you like, because that's what it's needed. It's to be out there, seen, understood, and aspired to. But it needs, back to our DNA, we need metrics around it as we're not comfortable. So I don't have a straightforward answer for you on that. I think that's part of the problem, actually. And I think it is a role of the club, as you call it, or our institute, our professional body, as I prefer to call it,
Sorry.
to do that. I think that it's a real role we have to play to give you that type of benchmarking data and the standard. Is it?
No,
Does
thank
that
you.
answered?
Yeah, no, it does. Because my sense was that it hasn't been fully defined, and I think it's important because social value, I think, means quite a a range of different things to people across the profession.
Sorry? You want to answer?
Yeah.
Okay.
Well, I was just going to make a quick comment, and it was interesting that the conversation this morning, and the point of the 20% value, and I think it can be very geographically based. I live in the U.S. and I can tell you right now, most of the corporations that are headquartered in the U.S. are not necessarily looking at social value being 20% of what they're doing. So I know that's much more of a focus here in Europe and specifically the UK. But I think it's something that we're going to have to figure out how it's going to do. I do believe that you'll see more of that in the U.S. over time, but we're not there yet.
I have no idea where this 20% social value number comes from or even what it means. It's not in legislation or anything. It may be some public bodies have some sort of goal, but I don't know what it means. Is it 20% of spend is with social enterprises? Is it they're trying to get 20% more non-cost value from social value stuff? I don't know. Just seemed to me to be made-up numbers. So that wasn't what I really came down to say, though. But I couldn't resist because I thought it was a strange thing. Anyway, I was going to go back to cost and savings and stuff and just make the point that in my 30 years' experience in procurement, 90% of organisations, 90% of their cost savings numbers they produce are a load of bullshit. And totally unreliable. I'm sure Rio Tinto is one of the few exceptions, and the other CPOs in this room as well. But I've always given the challenge. I wrote a paper for the UK government on this a few years ago. I've always given the challenge to CPOs, because when I say this, they go, oh, but ours are right. Say, OK, well, let me have a look at them and send me a copy of the methodology you use to record and measure your cost savings. And if you're right, I will back down. I'll write a lovely article about how good you are on this, and nobody's ever really come back to me on that. So, and I'm afraid, sorry, Hackett, and McKinsey for that matter, it's one of the sort of myths of procurement. Lots of us have made, I've been a consultant, made money out of selling how procurement can make cost savings or benchmarking on cost savings, and yet the numbers we're basing it on are a load of nonsense in most cases. And we get sucked into this discussion about cost reduction, cost savings, and as we've said today from several people, it's not where the profession should be, and yet it's all based on shifting sands and lies anyway. So how many people are claiming huge savings based on the fact the oil price has halved? Every large organisation, the procurers go, yeah, great, we've made millions of savings because the oil price has crashed.
No, you're leaving now, no?
Apparently, I was supposed to be on this panel anyway. They forgot to ask me, and I forgot to come up. Okay, no, for Peter's sake and for your sake and for your question, where it comes from is this. Okay, so the Social Value Act did not prescribe a percentage. It had no teeth whatsoever. All right, 2012. It was enacted 31st of January 2013. I carried out the first social value assessment, and it was called SCAPE. It was a contract in Nottingham, and it was 385 million. Okay, and I did it on both sides of the fence, which I don't do anymore. I did it for the people who are bidding, the building companies. It was a social housing contract, and I did it for the framework contract on the side. We delivered in the end 14%, not 20%. But at that time, nobody mentioned 20%. What then happened was the first year, the Social Value Act, because it has no teeth at all, was completely ignored by procurement professionals in the public sector, as Peter knows well. Nobody listened to it. They said, we have enough headaches for financial value, forget about this other stuff. In the second year, suddenly it took big take-up. I can't tell you why, but local authorities, NHS, trusts, etc., suddenly thought, my God, we've got no money. If you want clarity what that means, look at Birmingham City Council, has a procurement budget, had 4 billion in 2008. It lost 1 billion because the government took it away because they're Labour. They lost another billion because they lost a court case about gender discrimination over 10 years. And so in the end, they have £3 billion budget now, and they have to save 840 million every year. So that means all statutory services have got to be done, but all non-statutory services have now no money, nothing left in the kitty. So no parks, no libraries, no mental health units, no arts, no swimming pools, no leisure centres. So then, the same message throughout the UK, local authorities started, it wasn't planned, started thinking, what instruments can we use to deliver these services into the community, because we've got no money. And so people started using the Social Value Act, even though it had no teeth, as an excuse to make private sector companies deliver those things into the community. And that's how it started. The figure 20% came like this. Every time I spoke to any minister, etc., they use the figure, 20% is a marketing thing. They go, not about social value, they go, we're going to have cutbacks about 20%. And then the following year, it'll be another 20%. Because if someone said to you, we're going to cut backs of 60%, you wouldn't vote for them, would you? 20%, you go, yeah, okay, sounds kind of reasonable. Right? And then, so they went, well, this is actually replacing that 20%. Separately, the EU brought legislation under what's called anything to do with social impact funds. Things like in the UK, you'll know it as LEP funding, local enterprise funding. Any money that comes from the EU has to now deliver 20%. That was a separate conversation. So what basically the combination that came together, and it's not legislation and it's not law, but what's practically that happened is this. Government organizations are using any range, I've seen it as low as 5%, I've seen it as high as 20%. We do a lot around 20%, as a target to go for. They also have ignored the fact that Social Value Act is only supposed to be for services. They use it for CapEx. And also it's supposed to be for OJEC, which is 177K and above. They use it for paperclips as well. They use it for everything. So late last year, Lord Young did a review, took over from Hazel Blair, so ran a cross-parliamentary commission, and he did a review of Social Value Act to try and make everyone come together on this basis. And the report came out February. We're in that report. One of the 4 metrics he recommends, we're the only SaaS platform he recommended, because we're kind of volume-based. And that's how it's come. So it's pragmatic, it's not law, and that's exactly how it is. And hopefully, but basically it's the direction of travel. Throughout the world, they are moving towards this. And what does it actually mean? We actually mean delivering 20% off the contract value. And we do this now regularly for local authorities and so on. So, for example, we're just doing 1.5 billion. I can't name it, but it's actually 20%, 300 million pounds of values that you have to deliver into that, the swimming pools, et cetera, libraries. That's how people have interpreted it.
And you think suppliers are going to deliver that without that coming into their overall price?
Yeah, no, let me explain to Peter how it works.
No, I think we should stop this discussion, actually, let them talk about something else.
Well, I'm on it now, right?
You're on it.
I'm on it, right?
You're on it. You're on it. He's not. You are.
Yeah. There you go, Pete. There you go, my friend. Okay, so.
I want to hear Mark say anything here.
What can I say? So let me say it and then I'll leave, all right? How's that? I'll actually walk out the door and leave you all to it. The way it actually works is not 20%, as Peter quite rightly says. It's not 20. Let me finish the sentence and I go. It's not 20% someone's going to give you a check for 300 million. Who can do that? Who can do 20% contract value? It's the values brought into that community. That's 20%. Not a check for 20. No one can afford that. Usually, our analysis is the cost basis of 1%. What does that mean? Any transfer, any contract post-signing is usually, in the public sector, on average, 20% variation of contract post-signing. So in other words, the public sector says, can you build me the bridge? And then 10 minutes later, go, oh yeah, can you make it yellow? Go, oh, that's another 5%. Oh, can you actually perform more nuts on it? And oh, that's another 10%. So 1% is like a rounding error, all right? That's how it works. Thank you very much.
So before I do look like the dodo sitting on the end, maybe I should try and add some value. Back to Chris's point about protecting margins, I think there's a part there, and I'm agreeing with a lot of the stuff in here, so I'm trying to find how I challenge it. But I think it's protecting the current margin and the future margin of the organisation. And some of the examples Chris gave wasn't just external spend or costs, it was internal costs. And I'm interested to get David's view on this in terms of procurement's role of actually looking at the internal costs and how is that part of our future role as well. We seem to have this skill set of looking at costs as externally, but also we seem to stop when we look at the internal costs. Is that the future of one of our balanced scorecard KPIs in the future?
Thanks. It may be. I don't see that as the future of the profession. I think that's just going to reinforce what's a lot of people think of it anyway. And I don't foresee procurement professionals of the future being driven by that type of activity. Not if they're going to. The function's going to keep on growing as it is now, which I'll talk about in a minute. What's left of my presentation.
But I do think make versus buy is increasingly a discussion procurement gets involved into, and therefore I have clients who actually discuss what is the value add actually of outsourcing more or insourcing more, right? So this is definitely part of the discussion and part of the value they actually measure as delivery of procurement. So I think that's already happening now.
Whose role is that then? If
So
it's not procurement's?
Procurement
David.
actually would bring,
But
bring
I'm
up.
just wondering whose role that is.
No, I didn't say we can't do it. And insourcing is a key part. I mean, judgments on insourcing, which is now quite a trend,
Or outsourcing,
and
yeah,
no, particularly insourcing. We have to, of course we do. But I was trying to make the point that that's not something that I want to see the profession being seen as doing. This is back to your policing and your negativity of stopping things rather than creating things. We have a role there because it's part of, as I said in my example when I was in my last company, where we have to go forward and say what's the best value for the company of where your value add is and where it isn't. What processes do you get rid of and what don't you? Of course, that's fundamental to what we do. I maybe misanswer. What I was trying to get across is it's not what I see as a core part of what I want to see the profession doing in the future.
I just wanted to talk about the is it better for costs to go up or down again? And I would hate for anybody to think that everybody in public procurement's just thinking about social value acts and not actually core elements of how we do things. And I mean, I would say, don't you think it depends? So, for instance, if I'm going out and we're buying toilet paper for schools, right? Do we want the cost to go up on that or down, where you've got a whole life cost, how many sheets per pupil are we using? You might want to go on that, or you might say, actually, that's somewhere where we want costs to go down. But when we're buying something like an addiction prevention service, then that might be something where we want costs to go up, because back to what you're saying about value added, it's about where it's adding value. And I think that's where the analysis needs to come. So where the things you're buying are adding value to your business and the outcomes and achieving your objectives, then perhaps that's where you don't want to be short-sighted about costs. But where stuff isn't, and it's just the nuts and bolts of your organisation actually functioning, then perhaps that's where cost goes down. So I don't think it's as black and white as perhaps we're suggesting. And, you actually need to do that analysis first.
You want to go? There's a few here that got here before me. So I guess I want to kind of circle back to the margin point, because I think that in our experience, we're a service company, and we've got 60,000 employees. We don't make any products or equipment. And I think what we found as an engineering company, if we focus only on cost and not on the relationship with the client and the value we're adding every day, you reach a point of diminishing returns. And so I think that what I wanted to just promote was the fact that it's the cost plus the relationship or the value that you explained at the very beginning that's really the key. And unfortunately, I think with the conditions we're in right now with the market, I think that if you had a scale and you were balancing, I might call the value add versus the technical cost side, I think the scale is definitely tipped. So that what I'm concerned about is companies, whether it's procurement or finance or HR or whatever, how do we invest in balancing that scale while we're still realizing that cost is going to drive our profitability, our margins, but we can't be so cost focused that we're going to be so short-sighted that we're basically going to run the business into the wrong direction. So that's my concern.
So if we're measuring margin, how do we measure value add? And how do we... The Hackett speaker talked earlier on about customer experience. I didn't get a sense about whether that was an internal or external customer, but certainly I agree with you. If there's a service-based organisation and you're only driving margin, at some point you're just going to burn everybody out, and there has to be some value add. But the question back was, how are we measuring value add?
It's a great question. I've been thinking, as we've talked about the trusted advisor, for us, and taking the side of the customer, being our own customer. For us, it's being a customer advocate. That means you're acting and behaving and thinking as if you are actually the customer. Now, how do you measure that? We measure it in repeat business. We measure it in how many times a customer comes back to us, and we have a pretty good rate there. But we also have a lot of defectors that have left, and then we'd go survey them and find out what happened, what went wrong, where did the relationship break down, where did the value break down. But it's not an easy thing to measure. I mean, we're looking at earnings per share, obviously. We have a very aggressive double-digit growth objective, and honestly, I think it's bumping up against our customer model right now. And it's interesting to see the transition from being very relationship-oriented to now saying, how do you retain that relationship in the context of the markets we're in right now and still be competitive? So I didn't answer your question on how to measure. We do client satisfaction.
I didn't actually expect you to answer it, but...
We do all the data things. I was sort of interested, and I'm going to turn this over. I'm dominating. I'm not meaning to, but just to answer your question, we did a lot of the technical things that Chris showed on the slide. I don't know if you remember, he had 3 boxes on building client advocacy or client relationships, and the far left was really more about collecting client satisfaction data and those sorts of things that were a little more technical. And then I guess as you go to the right, it's probably more developing a partnership and relationship. So we do that, and we have good client satisfaction scores in the 94-95% range. But how good is good?
And do you not think that you're, where you go for the cheap and cheerful option as something that you might buy in, that's where your customer satisfaction from the client satisfaction rate might go down? And I'm thinking of where we had a national contract in Scotland for stationery, where it was, the price-quality ratio for that contract was very skewed toward price. The provider changed and we got a much more cheap and cheerful product there, but actually the amount of customer dissatisfaction from, you wouldn't think you'd get dissatisfaction about pencils and paper clips, but you do. So you've pushed it too far there. So the drive for the lowest can be the one that actually causes you as a procurement function a lot more customer dissatisfaction than having that balance a bit more towards quality, perhaps.
My answer might be to that. If you lose your differentiation while you're trying to cut your costs, then you're dead. So that's a quick answer. I need to share this mic.
We've got about 2 minutes to close out to be able to have 15 minutes for tea. So who's going to close out?
So as a company at the moment that's going through some specific challenges in the oil and gas field, and being part of the downstream organisation, which is actually a bit counter-cyclical to what's going on with the oil prices, we have some specific challenges there. So firstly, we measure gross margin to total cash costs. That's our measure of effectiveness in the business, this single unit metric, but that seems to be the one that gets a lot of focus. And where we are from a procurement side at the moment is our relevance in that conversation is quite narrow, and we're trying to improve that. But because we only deal on the price side, and I heard the argument around procurement cost savings are all bullshit because we don't really have this reference point. It is because I don't control the volume side. I'm on the price side of this. We use some historic nature to say, all right, this is what the saving might be worth, but really we don't have this view of the future. So if I went back to that original conversation is, are we paying too much? Are we not paying enough? Is I'd say, well, it should be our role to provide the insight to the organisation that we are actually paying the right price, and that price matches what our position is in the market, and nothing more or less than that.
I think that's as good a point as any to draw this to a close. Thank you for illustrating a fishbowl. I suppose in the true spirit, it normally is a circle with us as an outer circle. So in a sense, we encourage you to talk to us rather than to each other. But many, many good points. Thank you very much, all of you, and everyone in the room who contributed. Thank you.